Hello, and welcome back to the Meaningful Dividends podcast. As always, we're thrilled to have Dean, the boss, back in studio with us. Particularly love it when the boss comes in on a real heater and came in this morning. And, and we wake up and the first thing we do is check markets. The first thing, we're obviously doing coming in is looking at what's happening. And pretty quickly we start talking to people about this. And maybe a consistent theme that we've heard is just the concept, whether from clients or especially just kind of in the media, of markets have been really volatile. And it's been an up and down month, but Dean came in on a bit of a tear and want to give him the chance to let that out. So take it away. What do you got for us this morning?
Well, I think most of our clients we're hearing from, but just people in general, you hear it in the news, you hear everything. Everybody's talking about how volatile the market's been, right? How crazy things are. And certainly we've had this whole invasion of Iran. We're going in the Middle East where we've got wars and all kinds of stuff going on. And it's like people forget history. I mean, in my 40 years, we've been doing this all the time. It comes up all the time. And I was going to share, I shared my screen with Brock and we can take a quick look and see. This is just a S&P 500 chart. This is the SPY. So this is an ETF that tracks the S&P 500. And this is the last month, right? And it has bounced around when you look at it from a 1 month perspective. But you start to jump out to even, let's just go year to date, right? Yeah, it's been volatile. Let me get to the right screen. But it's been pretty good. Volatility's been great, right? We had this sell-off here when we started the Iran war, and we've actually done pretty well. Now, the last month, we've kind of gone sideways, right? But let's just take a peek and go back to 1994 and look back, not quite as long as my career. It's not even hardly a blip on the radar. So that leads to our conversation that Brock and we were talking earlier about, let's not get caught up in the emotion of a news cycle, but our role here is to provide good data so that we can make thought out and meaningful decisions.
Yeah, and the term that has been coming up in our investment committee meetings is the concept of intellectual honesty.
I
It's looking at the data and just being honest with what it's showing, right? And I want to pull up another slide here of like what we use to talk a little bit about our process. Is that we have different what we call elements, essentially they're algorithms that we use to help track data across like broad fields, right? So that we can track things very quickly. And if we want to, we can drill down very granular, but that we can get a look at what it is. Some of these,
maybe I would jump in and just say,
yeah.
These algorithms, just for people who aren't familiar, it's not one single piece of data. It's actually an amalgamation of a group of data grouped into subsets of trend type things or volatility type data. And so maybe that helps people.
Yeah, absolutely. And so we have kind of two classes of elements that we use. One set that informs how much we should be leaned into or leaned out of the markets, right? Say how much gas, our foot on the gas versus foot on the brake. And then also just what we call our style elements of whether we're leaned in or leaned out, where should we be invested in the many different asset classes that we could. And so the trend element is one of our level elements, this idea of how much should we be in or out. And again, it's a combination of many different data points. But in general, what it's looking at is how has the market been doing over the last couple of years? And this idea of intellectual honesty comes that we're currently at a trend of 10%, which roughly means that we could experience, a 10% pullback. This is general. Don't try and track this just on your own from what I'm saying. But roughly we could experience a 10% pullback and we'd still consider that normal market movement. And that's because we've had a couple of years of great market growth and most of our clients have benefited greatly from that. And we need to be intellectually honest with ourselves that if we saw a pullback here, that we would still be ahead of where we were previously. And so there's a lot of noise. There is some volatility going in the markets, but when you boil it down to some of these just like pure data points, no spin, we're sitting in a position that the market still looks quite strong. And until we see that change, we're going to continue investing according to the data.
I like that.
Well, then let's jump to another point. So this next point I want to talk about is I want to talk a little bit about the Fed and what that means. Because when we talk about data, one of the main data points that the market has used over the last few years has been coming out of the Federal Reserve meetings, when Jerome Powell would come out and he would kind of lay out what Fed policy was going to be. One of the things that we're starting to see is that while we anticipated that we might be on a rate cutting cycle, we've seen that inflation has remained persistently sticky. That's been around. Inflation has been higher than we want. Maybe that's geopolitical. Maybe there's other causes, but it's here. That's undeniable. And so what we can see in the market is that, in July, probably going to stay at where the Fed's funds rate is right now, between 3.7. But going out to September and October, you start seeing a higher likelihood that the Fed will raise rates. So this is a shift in what we were expecting as markets, right? Rising interest rate cycles can exert pressure on both bonds and stocks, and so it's something we want to watch very closely. But Dean, you were listening to the new Fed chief, Kevin Warsh, just this morning, and I thought you had a really interesting insight on how we should be thinking about the Fed data going forward.
Yeah, I mean, if we just think back a few months ago, right? I mean, I think you and I have been kind of pro Jerome Powell, right? In general, I mean,
Yeah, we liked Powell. I like that.
there were a lot of things about him we like. That doesn't mean he was perfect and he didn't make some mistakes. He probably, he and the Fed, they're people, they make mistakes. But what what happened was under Jerome Powell, and it didn't just start with him, is the Fed, when it's in crisis mode, became extremely conscious about forecasting what they were going to do in the future. And so the Fed meeting wasn't so much about what happened, because it was almost a given that the market knew what was going to happen at the Fed at the end of their meeting. It was more about what the press conference was afterwards, when he gave guidance into the future. So markets almost stopped pricing things out and just waited for the Fed, and the Fed was the data. It wasn't the other way around. So when President Trump was going to nominate somebody, and we know he had issues with Jerome Powell and whatever, he was trying to find somebody else, there was a lot of concern that the new Fed chair would, one, just kind of follow what Donald Trump wanted, for better or for worse, depending on which side of the political spectrum you are. And there was some concern about the independence of the Fed. And again, I think you and I are both more believers in an independent Fed and why that's important. Well, what we've learned just in the last 4 weeks since Kevin Warsh has been there is that he's a very smart man. He has a group of people that are very smart. We don't expect they're perfect, but they are different from Jerome Powell. But they are very committed. And I heard him speak this morning with a group of central bankers from around the globe. They're in Portugal right now having a meeting, and they were talking about this. It's clear that he is dedicated, they're all dedicated to an independent Federal Reserve or their own central monetary committees, right? They're very much still focused on a 2% inflation target. But if you listen to that interview, it was almost comical. Just in the half an hour or so that I was tuned in, there must have been 7 or 8 questions by the moderator trying to get them to make forward-looking statements. And every one of them said, we're not going to do that. And that was a big signal to the markets, to everybody, that if you're waiting for Kevin Warsh to come out and say, hey, I'm going to tell you what interest rates are going to do in October, you're going to be sorely disappointed.
And that's a big change. I mean, like
That's
that
a
idea,
huge
like the
change.
Fed is not going to try and forecast what the policy is going to be, because
Yep.
that's really been the game, for lack of a better term, for the last few years, of saying, well, this is what interest rates are today, and what did the Fed say they're going to be in the future? Because Jerome Powell, and maybe you said this already and has missed it, but I know in another conversation you talked about this, that they were very good at telling the market beforehand what they were going to do, which maybe in a time of crisis was really needed, right?
Well, and just in honor of Alan Greenspan, who passed away just recently at 100, good for him. That's one of my first Fed chairmen that I remember, Alan Greenspan, famous for his quote, irrational exuberance in the stock market. But it wasn't uncommon 30 years ago to have the Fed surprise you at the end of their Fed meeting. Nobody thought anything was going to happen, and they would raise rates 50 basis points. and there'd
Sure.
these big shock in the market, and it would all adjust, and then it would go forward, or they would cut. But it was rarely forecasted, or not forecasted, but forward kind of
Foreshadowed, maybe? Is that
foreshadowed. Yeah, they didn't tell you what was going to happen. They kind of did what they thought was the right reaction, and they used that surprise to their advantage. And they thought it got them. Sometimes they would make a bigger cut or increase specifically to surprise the market. Anyways, so here we are in a new environment. I think we can safely assume that Fed independence is alive and well with the current Fed chairman.
which is a good thing.
I think it's very evident to me in just the last 4 weeks that it's not going to be cut rates, cut rates, cut rates, market be damned kind of thing. It's going to be very much data driven. They're setting up different task forces and other things. He emphasized that in the private sector in the last 20 years, 30 years, 40 years, they're constantly upgrading their data sources. I think anybody that's followed the Fed for a long time, most of our listeners will understand that some of the data that comes out from the government, CPI, just a variety of indicators, can be slow, can be unreliable, gets revised, and it's very much looking back in the rearview mirror. And I think what these task forces will help them do, and what their goal is to have more real time, more data that helps them maybe see what's actually happening now. So when they make moves in the Fed, it's not based off 2 months ago data, but maybe if they can get there real time, what the actual situation on the ground is. Those were all, I thought, very positive
Very
developments.
positive and very interesting. I mean, you're right. I mean, the Kevin Warsh has only been in for a month, and I mean, I know that students in the market like us have been very interested to see what he's doing. There's some
Yeah.
very interesting shifts in how the Fed will operate. Though I think, to your point, like it's sticking to some of the core principles that we thought were important of independence, data driven, very measured responses, right?
It lines up well with the Kimball Creek Partners philosophy on
Well, it's
market.
obviously how we like to manage money, right?
That's
And
where
it's
we
not
look. So we feel great about this. You
likewise
should
here.
follow the
So
data. You should do that. Anyways, but to your point earlier, now that the markets are kind of having to pick where they think rates are going, I think we've
yeah,
seen this shift. Okay, we've gone from Jerome Powell. We thought we were getting a nominee that might just follow what the current president wants to happen. And now the markets, I think, are realizing, well, that's probably not it. It is an independent Fed. It is going to be data driven. And they're forced to look at what the data says. And the data says inflation is still too high,
yeah.
or still higher than people would like it. And so they've now priced in, again, these are markets that some of you may not pay attention to, but we can see the markets looking out 1 month. Looks like there's probably no change. Markets are saying maybe in September we could see a 25 basis point hike, and maybe even another 25 basis point hike in early 2027. It doesn't mean it has to happen, but that's what it's predicting. Okay.
Let me jump you off in the interest of time. Let's jump to our next topic here.
Great.
Just one of the roles that we hope we can play for clients is helping them sort through the noise, right? The media from actual data to entertainment, like what is it? And one story that came out recently in the Wall Street Journal, this was the headline: "The $1 trillion borrowing binge lifting the stock market to risky new heights." And this article is making this argument that leveraged funds, as you can see in the bottom, and margin debt are at these all-time high levels, and this is going to signal a potential catastrophe waiting in the market. Now, not to minimize the uses of debt or anything like that, because they are things that we should watch and pay attention to. They can be dangerous for markets, but we have to put this in context. So let me put it in context with some data. What the article fails to do is show that, yes, margin is higher, but so is the stock market cap, right? So on a pure dollars basis, there's more margin out there, but there are also just more dollars out there to begin with. And so when you start adjusting for inflation, you make it not just a total amount of debt, but a ratio between debt and the overall market cap that is out there. This is where we are today at 2.1%, which, yeah, is quite elevated from where we were in January of last year. And so you could understand how this article initially could get written, or how this could fall on somebody's radar of, we've had a run up in margin. But from a historical perspective, we're not where we were at in the dot-com. and we're nowhere near where we were at during the great financial crisis. And if we kind of break down this data even further and say, well, on a percentage basis, like where do we fall on the bell curve of all different uh all different, levels that we've been at?
Yeah, maybe I'll just jump in. I'm just gonna throw out a quick example for listeners who may not quite catch this. Let's say you have NVIDIA, for example, huge company, where they have $4 trillion market cap right now. Are we there yet? 3 trillion today? Let's say four. We have a company, ABC, is worth, 10, the total value of the company, if it was worth $200 billion and you had 50% margin on that position, that means, right? If you had 200 billion, that means your margin debt was 100 billion and you had 100 billion in equity. Well, now if you have $1 trillion company, you might have a $500 billion margin debt for the same thing versus the 500 million market. So what we're explaining here when we talk about market cap is the value of all the stocks that are being bought is so much higher that yes, the debt on an absolute number is higher, but as a percentage of the asset, it's actually lower. That's what this chart's adjusting for.
Yeah, and so here's kind of calling out the numbers. If you look at the total market cap of the S&P 500, back in the dot-com era, it was 11.4 trillion. Today it's 67 trillion. So when you start controlling for those numbers, that yes, our margin debt at 14, 1.4 trillion, am I saying that right? Yeah. Is big. That's a big amount. But it's, as a percentage basis, it actually falls right around the 43rd percentile. Again, not something that I want to be dismissive of necessarily,
Yeah.
but also not something that I want to be too reactionary to, like that article may have led, and that I know that we had some questions
It
about.
sells more newspapers if you use the absolute number, but it probably isn't. I mean, again, we're not trying to dismiss it. We watch it, we care about it, but it's not quite the same level as they're talking about impending doom this minute. Now that we've shifted to this expectation that rates could rise, that is a shift in our investment. We're paying attention to that because the difference between being in a falling rate environment and a rising rate environment will impact maybe not the level of equities we have, but it might impact the type of equities that we have.
I mean, if you're one of our clients and you're looking at your accounts, you'll see that there was some activity going on. That was less about this idea of should we be in the market or out of the market, and more where should we be positioned within it. There is opportunity and risk throughout this market. You look at companies like Microsoft that are down 20% off their all-time highs. Is now the time to buy Microsoft, or is now the time to be defensive against a wider sell-off in the tech markets? That has a lot more to do with an individual investor's goals than it does what is known in the market, because everything that is known is reflected in the price. It's like what we believe, right? Going forward, for some clients and for some models, we run 20 different models, 21, actually, I think is the exact count. So we run 21 different models. Each client gets fine-tuned a little bit based off their own personal objectives with some customized holdings. And that's all driven at this idea of how much risk can that client take? How much risk does that client want to take? And where do we think the best risk-adjusted returns come for that client? And so we're making moves all the time, typically twice a month is how often we trade, reserve the right to do it more often. But we do that with an eye of what is the client's goals? How do we keep them on track? And how do we make sure their money's working as hard as it can be within like their stated risk objectives?
Yeah, I think that's a great. I just think that's important that people see some of these shifts, even when we think the market, the broader market, still looks attractive, still has a reason to participate. That doesn't mean we're going to use the same tools to participate.
And so it can be hard in formats like this to maybe say exactly like why we're making every single move, because the moves can be very customized. But if you're looking at your accounts and you have questions of, gosh, why are they buying this and why are they selling this, and what's the rationale, please reach out. We have lots of charts and graphs and data, and it's something we think about a lot and we love talking about it. So if you have an interest, if you have concerns, if there's somebody in your life that is asking you questions that you think we should talk to, please reach out or have them reach out, and we'd love to have a conversation. For Dean and for Brock here at Kimball Creek Partners, thanks for tuning in, and I hope that
Have
this
a great
conversation.
4th of July.
Have a great 4th of July, 250 years. 250 years. Yeah, go out. eat a burger, be responsible with fireworks, pray for rain, whatever you think is appropriate. But anyway, I hope you have a meaningful week, and I hope this conversation pays dividends in your life. Take care.